Hey, good Sunday morning, everyone. This is Anna from HotOptionBabe.com. I want to walk you through another trade on an earnings that's coming up, which is Apple. And I want to show you a couple of reasons why I might adjust this trade and why I may not adjust this trade. Now, Apple is out Tuesday after the bell, so I am already in. As you can see, I have positions in the Apple 220 August puts. Now, this is what the chart looks like along, I meant to analyze. This is what a long put looks like. This is exactly what it looks like. It looks like short stock basically, but you're protected because you have only the debit of which you could lose. Short stock, you can lose all the way till the stock goes to zero. In actuality, not going to happen most likely, especially with a company like Apple, but you have to be aware if something moves really. Let's say you're short Apple and it's at 250 and it goes to 280 because they beat earnings. Wow, you're going to start feeling the pain, and you're going to want to, and that's where all this short covering comes in, short squeezes that you hear of, because what's happening is the shorts are scrambling to cover their position, so they have to buy back the stock that they sold. So that's the reason that I do options. I like to be able to do bearish and bullish positions, but by doing short stock, you have risk to zero if you are if you're shorting a stock. If you're buying a stock, you have risk to zero. So you need to realize that there's a lot of risk in doing that. So with options, you're only limited to the risk of your debit. Now, I love when it does this. And right here, as again, we have a long put. Here we go. This is where you would break even at 216.47. Everything else you see, you would start to make some money on. Okay, so I actually have 6 of them, and so I have about $2,000 invested in that. So let's go back over to the trade box, and what I want to show you is why you might not want to keep, or why I might not want to keep long puts on Apple into earnings. Now, what I'm going to show you, here's my position, the 220 right here. Okay, now you look at the implied volatility, it's 46.68. Now that's not really high for Apple, but I expect that that's going to start pumping up right before the earnings come out on Tuesday. So I'm going to keep my eyes peeled on this implied volatility. If that continues to rise, as I believe it will, then I don't want to keep straight puts, because what's going to happen is I'm going to end up getting what's called an implied volatility, or IV crush. Okay, and that's bad, because what happens is they pump up your option before earnings, and once the earnings come out, the market makers suck out that volume. The premium, suck out that premium, and so you're left with. You're scratching your head, well, why didn't I make more money? Okay, I don't understand it. Well, that's the reason, okay? So you have to be aware of your Greeks at all time. Now, the delta on that is not huge, but as I mentioned, Apple can move quite a bit. Just like Google, I did the butterfly that netted 800% in one day. Now, we don't have options expiration to work off of, so I won't do a butterfly on Apple. I will do either, if the volatility remains low, which I highly doubt, I will stay with straight puts. But if the volatility starts to rise, especially, it's relatively, it's not insane yet, but I expect Monday, Tuesday to get much higher. But as it rises, I'm going to want to offset that volatility. I'm going to want to sell that volatility and capture that premium that the market makers are pumping up. Okay, and not only do I capture by selling the IV or selling a put that's a little bit further away from mine, I also am limiting my risk. So if I'm wrong, okay, I have that put that I sold that will take some pain too. So that will limit my risk. So most likely what I'm going to do is I'm going to look at the 210 or the 200. Now, I advised somebody last night, and I said I never sell an option for less than $1, and I don't, because it's not worth it, basically. Dollar's my limit. So you can see the 200s at 114 and 116. I expect that to rise, okay, especially if Apple drops a little bit before earnings, or if it rises, the implied volatility might rise. You can see the 200 is actually higher than the 220, because as you get further away from the money, they pump up the premium more. Okay, so let's go over to the chart. I'm going to have to make this quick because I'm going to run out of video time. But I just want to show you on the chart, or on the analyze chart, the long put. Now, I'm going to add 6 210s. I'm going to sell, say, Tuesday afternoon, wherever it's at. I may do the 200. I have to see where Apple's at that point. But if Apple moves a lot, I might want to do the 200s. So I'm going to click on this add sell Apple 6 August 210s, and you can see what's happened. That long put has lowered my risk. You can see where it was up a little bit higher before. Take it off. Look at this. Look at the risk difference, okay? You've lowered your risk, and you've created a spread. It's a bear put spread. So that way, even if you're wrong, you're going to have some protection because you sold the puts. And even if you're right, you want to stay away enough from that short strike that you can still make a lot of money. So there you go. I hope that helps you out a little bit on what I do. For $100 a month in the lounge, I mean, what I do is I do all this stuff for you instead of you having to figure all this out, which is a lot of work. But I do it, and I do it. It's second nature to me, so it's really easy to do. So I wish you all the best of luck, and I hope to see you in the lounge. Bye.